What if a country could shrink $1 trillion debt not by paying it off, but by shifting the global financial spotlight so no one notices the numbers changing in the dark? What if the real power behind a nation's stability wasn't cash reserves or interest rates, but control over oil flows and rare metals that the world cannot function without? These are the questions that quietly surround China's current economic strategy. And the deeper you look, the more unsettling the pattern becomes. Most analysts focus on China's slowing growth, its real estate crisis, or the staggering amount of hidden local government debt. But almost no one pays attention to the silent mechanism Beijing is using to rebalance its financial position without triggering panic across global markets. It starts with a simple but explosive idea: commodities can behave like shadow money when controlled at scale. Instead of reducing debt through traditional fiscal tightening, China is converting strategic commodities into economic leverage. Oil, rare earth elements, lithium, cobalt, nickel, these resources operate outside the visibility of conventional balance sheets. They don't appear as cash, yet they influence everything from supply chain stability to global pricing power. And when a nation controls the production, refining, and distribution channels of these materials, it gains a financial shield that offsets debt without ever announcing a reform. This strategy works because commodities hold intrinsic value independent of financial volatility. Their worth rises with geopolitical tension, technological expansion, and global scarcity. So while Western economies track debt to GDP ratios, Beijing monitors something different: the margin of influence created when critical resources become bargaining chips instead of line items. And here's where the twist sharpens. Every barrel of oil secured through long-term contracts and every shipment of rare metals refined within Chinese borders reduces exposure to dollar-denominated liabilities. It shifts the axis of vulnerability toward the rest of the world. China is not escaping debt by eliminating it. China is diluting its impact by anchoring the future of energy and technology to assets only it can fully supply. This raises a question that countries rarely dare to ask out loud. If you can control the inputs of global industry, do you really need to fear financial pressure the same way others do? You already feel how different this approach is, and the more we unpack it, the more you will see why understanding this pattern matters. If this already shifts how you see China's economic moves, share in the comments what surprised you most, leave a like to support this investigation, and check whether you're subscribed, because what comes next will connect these pieces in a way that may challenge everything you thought you knew about global debt. To understand how China masks internal financial risk while silently redirecting its economic center of gravity, you have to look at what is happening behind the official numbers, the ones published for investors, rating agencies, and foreign governments. On paper, China's debt levels appear overwhelming, dispersed across local governments, state-owned enterprises, and shadow financing vehicles. But Beijing has built a system where these risks are absorbed, diluted, or temporarily hidden through strategic repositioning rather than direct correction. And the heart of that repositioning lies in commodities so essential that their global importance makes financial transparency almost optional. Inside China's financial architecture, state banks operate less like profit-driven institutions and more like conduits for national strategy. When Beijing wants to redirect attention away from rising liabilities, it does not announce sweeping reforms or dramatic austerity measures. Instead, it quietly channels credit towards sectors that strengthen resource security. Oil refining capacity expands. Rare metal processing plants receive accelerated funding. Storage facilities grow. Strategic reserves deepen. To outside observers, this activity looks like industrial policy. In reality, it is a mechanism that shifts financial exposure away from fragile assets and into the raw materials that anchor the future of global manufacturing. This tactic works because resource-based investments behave differently from traditional financial instruments. They appreciate during geopolitical stress, withstand inflation, and gain value as the world becomes more dependent on electrification, batteries, and renewable energy systems. While Western economies hedge with derivatives or fiscal tightening, China hedges with physical control. Every ton of rare metals processed within its borders strengthens the insulation around its debt by ensuring that global industries remain partially dependent on Chinese supply chains. That dependency acts like a pressure valve, redistributing financial vulnerability outward rather than inward. Even more revealing is the timing. When debt levels rise aggressively, China increases commodity accumulation. When real estate markets falter, strategic reserves grow. This pattern repeats with such precision that it becomes impossible to call it coincidence. It suggests that internal financial risks are intentionally offset by strengthening leverage over materials that cannot be easily replaced or substituted. These assets give China something no Balance sheet can fully capture the ability to influence global production costs without negotiating, to set terms in silence, and to stabilize domestic markets through control rather than transparency. As this machinery expands, it becomes clear that the Chinese financial system does not rely on trust in the same way Western economies do. It relies on indispensability. If the world cannot manufacture batteries, turbines, electronics, or energy infrastructure without materials refined or supplied by China, then China's debt burden becomes less threatening simply because its position in the supply chain makes punitive financial consequences unrealistic. What appears externally as economic fragility is internally transformed into strategic resilience, creating a system where resource dominance quietly absorbs the shocks that traditional markets would expose. The quiet shift in China's strategic reserves reveals something far more calculated than routine economic planning. When an upset nation increases its holdings of oil and rare metals at the exact moments when its financial vulnerabilities deepen, it signals that these materials are functioning as an informal counterweight to debt. This is not the traditional approach of strengthening currency reserves or tightening fiscal policy. Instead, China is building a protective shield made of assets whose value grows precisely when global uncertainty rises, and each adjustment in these reserves alters the underlying geometry of its debt exposure in ways that most analysts never account for. Consider the scale of these moves. China now purchases and stores oil as if it were a financial commodity, accumulating reserves far beyond what is needed for domestic consumption. These reserves act as an inflation hedge, an energy security guarantee, and a geopolitical bargaining tool all at once. But the real nuance lies in how they reshape the perception of risk. A country that controls a significant portion of global oil demand can stabilize or disrupt pricing simply by adjusting the speed at which it fills or releases reserves. This quiet influence effectively softens external reactions to internal debt pressures because dramatic market responses become less likely when China sits at the center of energy demand. The same dynamic unfolds with rare metals. China refines the majority of the world's rare earth elements, along with a dominant share of lithium, graphite, and other critical materials for batteries and advanced technology. These are not just industrial inputs. They are strategic leverage points woven into the future of transportation, energy storage, defense systems, and digital infrastructure. As these minerals become more indispensable, the value of controlling them increases faster than any conventional asset on a balance sheet. And while financial analysts debate non-performing loans or real estate defaults, Beijing focuses on securing materials that global industries cannot function without. What makes this shift even more powerful is its invisibility. Strategic reserves do not appear in the same categories as sovereign wealth funds or foreign currency assets. They grow quietly, without daily reporting requirements, without market speculation distorting their value, and without triggering political responses. This invisibility allows China to rebalance its financial posture without broadcasting the move to markets that react violently to transparency. The day-to-day movements of these reserves are known only to those who are meant to know, amplifying their effectiveness as a stabilizing force. As China deepens its control over these resources, its debt is no longer judged solely by traditional metrics. Instead, its economic resilience becomes tied to the scarcity, necessity, and irreplaceability of the materials it holds. The more dependent the world becomes on electrification and renewable technology, the more China strengthens its position without changing its public debt figures at all. This creates a paradox where rising raw material influence quietly offsets financial risk, forming a hidden stabilizer that Western economic models rarely include. As China's influence over oil and rare metals deepens, the geopolitical landscape begins to shift in ways that are subtle on the surface but dramatic beneath it. What appears to be mere participation in global commodity markets is actually the architecture of a leverage system designed to convert physical resources into financial and diplomatic power. This system allows China to negotiate from a position that creditors, rivals, and trade partners often underestimate, and the mechanism is not loud or confrontational. It works precisely because it blends into the background of normal economic activity. The transformation begins with long-term bilateral agreements. Instead of competing in open markets where prices fluctuate and visibility is high, China secures energy and mineral flows through contracts that lock in supply for decades. These agreements often include infrastructure financing, currency swaps, or development assistance that bind the partner country into a durable economic relationship. While the West views these deals as soft power tools, China uses them as financial stabilizers. Each contract not only ensures access to strategic resources, but also distributes risk outward, anchoring China's debt exposure to nations unlikely to challenge its terms. The strategy extends further when these commodities are priced or settled in alternative currencies. Every time a shipment of oil or critical minerals bypasses the dollar system, China weakens the global influence of the currency that underpins much of its external debt. This shift does not eliminate liabilities, but it alters the environment in which those liabilities operate. A world less dependent on the dollar creates conditions where China's debt becomes less vulnerable to currency shocks and international monetary pressure. It is a form of quiet insulation, achieved not through confrontation but through structural realignment. Meanwhile, Chinese companies expand their presence in upstream supply chains across Africa, South America, and Southeast Asia. By securing mining rights, refining contracts, and logistical infrastructure, China controls the flow of materials before they even reach global markets. This upstream dominance creates a geopolitical advantage that Western nations cannot quickly replicate. And as the world accelerates toward electrification and digitalization, the importance of these resources magnifies, giving China a stabilizing asset that does not appear in traditional financial reporting. The most intriguing consequence is that this geopolitical leverage creates a buffer around China's internal economic vulnerabilities. When a nation becomes essential to the functioning of global technology and energy systems, the international community hesitates to apply financial pressure, regardless of debt levels. The cost of destabilizing such a central player becomes too high. Thus, China's resource strategy subtly transforms geopolitical relationships into protective layers around its financial system. If this perspective opens something new for you, share in the comments what angle of this strategy you had never considered before. Your insight helps shape how we continue unraveling the deeper mechanics behind China's global economic power. The reconfiguration of global supply chains did not begin as a financial strategy, but China quickly realized it could function as one. When a nation becomes the central corridor through which critical materials are refined, assembled, and distributed, it gains an ability that goes far beyond trade advantages. It gains economic leverage that substitutes for traditional fiscal strength, allowing vulnerabilities inside its domestic markets to be absorbed by the interdependence of global industries. This is why China's role in supply chains is not just an operational choice. It is part of the hidden machinery that reduces the exposure of its massive debt. The strength of the system lies in how deeply it is embedded. China does not merely participate in supply chains, it shapes them. Through dominance in refining rare earths, processing lithium, manufacturing components, and controlling logistical routes, it ensures that entire sectors of the global economy rely on Chinese throughput. Energy technology, consumer electronics, transportation, defense systems. These industries cannot function without the materials and manufacturing capacity concentrated within Chinese borders. That reliance becomes a form of passive insurance, softening the impact of financial instability because global markets cannot afford disruption. As Western economies attempt diversification, China accelerates vertical integration. It invests in upstream mining, downstream battery production, and large-scale infrastructure linking ports, railways, and industrial zones. Each part of this system creates a layer of strategic insulation around China's financial vulnerabilities. A supply chain built around Chinese inputs behaves like a shock absorber, distributing risk outward and reducing the likelihood of external economic retaliation. And even when nations attempt to reduce dependency, the transition timetables are long, capital-intensive, and politically sensitive. This lag gives China room to maneuver economically without triggering immediate consequences. The most revealing element is how China uses these supply chain advantages to adjust financial exposure internally. When debt pressure mounts, state-backed companies increase production in sectors tied to global demand, redirecting capital into industries with strategic value. This creates a loop where external reliance fuels internal stability and internal investment reinforces external dependency. No Western model fully captures this because it treats supply chains as neutral economic structures rather than as instruments of geopolitical balance. This architecture also changes the way markets interpret China's risk profile. Traditional financial indicators assume that debt vulnerability increases when domestic sectors weaken or when credit systems become strained. But China offsets these weaknesses with assets that do not appear on financial statements, the ability to set global pricing thresholds, control choke points in manufacturing, and influence the rhythm of industries essential to the world's technological transition. These capabilities dilute the weight of financial liabilities, making them less significant, not by reducing them, but by changing the system in which they are measured. As the world continues to electrify and digitize, these reconfigured supply chains become even more central, deepening the strategic buffer between China's debt and the global reactions typically associated with economic fragility. What makes China's quiet reduction of perceived debt even more striking is how consistently it escapes the attention of Western analysts. The mechanisms are visible, yet the interpretation is clouded by long-standing assumptions about how financial stability should behave. Most countries telegraph their economic shifts through interest rate changes, fiscal reforms, or public restructuring plans. China, however, operates in a parallel framework where strategic assets take the place of policy announcements, and subtle realignments matter more than official signals. This disconnect creates a series of blind spots that allow China's approach to unfold without triggering the scrutiny it would provoke elsewhere. One of the largest blind spots is the reliance on conventional debt metrics. Western institutions expect financial transparency, open market reactions, and regulatory oversight to reveal weaknesses. But China's system is built to dampen visibility rather than enhance it. State banks absorb shocks, local governments recycle liabilities, and balance sheet risks are dispersed across entities whose reporting varies in depth and clarity. When analysts look for traditional indicators of distress, they miss the stabilizing influence coming from commodity leverage, supply chain dominance, and geopolitical insulation. The model they use to evaluate China cannot detect what China is actually using to stabilize itself. Another blind spot lies in the assumption that global markets respond uniformly to financial pressure. In reality, markets respond to risk distribution. When China increases its command over critical materials, it shifts the burden outward. The cost of destabilizing China becomes greater for other nations than the cost of tolerating its opaque financial structure. Western analysts understand interdependence, but they underestimate how powerfully it transforms economic vulnerability into strategic resilience. If the world's energy transition depends on Chinese lithium processing and rare earth refining, then China's debt is no longer a domestic issue. It becomes a shared international exposure. Even more subtle is the informational asymmetry. China releases macroeconomic data selectively, adjusts definitions when necessary, and emphasizes narratives that support stability. This controlled transparency does not deceive experts outright, but it fragments the available picture. Instead of a clear view, the world sees overlapping signals. Monetary tightening in one sector, expansion in another, reserve accumulation without explanation. Each move can be interpreted in multiple ways, creating uncertainty that slows decisive reaction. In that ambiguity, China gains time to rebalance internally while observers debate externally. The final blind spot is psychological. Western economies are accustomed to debt crises erupting visibly through market crashes or institutional breakdowns. China's approach denies these dramatic markers. Problems emerge gradually, are diffused quietly, and are offset by assets that operate outside traditional fiscal narratives. As a result, even when experts sense instability, they struggle to identify the trigger point or the corrective mechanism. The more China mixes financial engineering with geopolitical leverage, the harder it becomes to fit its behavior into familiar frameworks. This combination of misinterpretation, incomplete data, and shifting power dynamics creates the perfect environment for China's silent restructuring to continue unnoticed, even as the underlying strategy becomes more coordinated and more deliberate. As China's network of oil and rare metal agreements expands, the financial impact of these alliances becomes harder to measure yet impossible to ignore. What appears to be simple trade cooperation is actually a lattice of long-term commitments that redistribute economic risk across continents. Each agreement locks partners into predictable flows of resources, financing, and infrastructure, creating a global web where China stands at the center, absorbing value while dispersing vulnerability. This web functions like a stabilizing net under a high-wire act. The greater the number of connections, the less any single point of failure can destabilize the entire system. These agreements often stretch far beyond commodity exchange. They include currency settlements that reduce dependence on the dollar, logistics routes built with Chinese, financing and strategic partnerships that tie a nation's energy security to Chinese reliability. With every new partnership, China's role becomes less transactional and more structural. It is not merely buying oil or metals, it is embedding itself in the economic survival strategies of other nations. When those nations rely on Chinese-built infrastructure or Chinese-processed materials, their own financial stability becomes indirectly linked to China's continued economic strength. This interdependence creates a soft shield around China's debt system. Nations that receive Chinese investment or sell critical commodities under favorable long-term terms are less likely to challenge Beijing diplomatically or financially. They become stakeholders in China's ongoing stability, reducing the likelihood of coordinated pressure even as its debt grows. Western institutions may not appreciate the depth of this dynamic because they tend to view international agreements through the lens of trade balances or political influence. But the real mechanism at work is risk distribution. The more countries benefit from China's role in the commodity ecosystem, the more they share the consequences of any disruption. Another layer of this network lies in offshore financial structures. Chinese companies often secure stakes in foreign mines, ports, and processing facilities, creating profit flows that remain partially outside the reach of domestic financial volatility. These returns act as supplemental buffers, feeding liquidity back into the system while reducing the exposure of Chinese firms to internal market cycles. When combined with long-term supply contracts, these stakes turn global commodities into a decentralized financial stabilizer, one that grows stronger as China's presence spreads across resource-producing regions. What makes this network so effective is that it operates through cooperation rather than coercion. Countries join because they seek stability, development, or price security. Yet, in doing so, they gradually bind their economic futures to China's resource strategy. The deeper the integration, the less feasible it becomes for these nations to detach without facing significant economic consequences. This shared reliance becomes an invisible layer of protection around China's own vulnerabilities. If this kind of global web surprised you or made you rethink how resource agreements actually shape financial power, share your thoughts in the comments. Your perspective helps enrich this investigation as we continue uncovering the layers behind China's strategic economic moves. Inside China's financial system, the most revealing activity occurs not in the headline numbers, but in the subtle coordination between state banks and strategic industries. These banks operate with a mandate that goes far beyond profitability. They function as the financial architecture supporting China's long-term geopolitical goals. When commodity leverage becomes central to debt stabilization, these banks shift their lending priorities to reinforce exactly the sectors that convert raw materials into strategic advantage. This process transforms oil, rare metals, and industrial capacity into instruments that perform the same function as financial buffers without appearing on any official debt reduction plan. The mechanism is deceptively simple. Instead of tightening credit when debt rises, state banks redirect capital toward industries connected to global demand and commodity control, battery production, rare earth processing, energy infrastructure, petrochemical expansion. These sectors receive funding even when others contract. The effect is twofold. First, it ensures that China maintains dominance in areas where the rest of the world has limited alternatives. Second, it channels domestic financial risk into industries whose outputs are indispensable to global supply chains. This redirection effectively transforms potential liabilities into strategic assets by embedding them within markets that rely on Chinese capacity. What makes this system even more unconventional is how these industries convert physical assets into financial influence. When global demand for batteries rises, China benefits not only from increased exports, but also from greater bargaining power in international negotiations. When supply chain disruptions threaten other nations, China's capacity to stabilize prices or accelerate shipments becomes an unspoken form of leverage. These dynamics give Chinese companies operational strength that blends seamlessly into geopolitical advantage, allowing financial vulnerability to be offset by relevance rather than transparency. This synergy becomes clearer when looking at how internal debt cycles play out. In most countries, rising corporate or local government debt triggers tightened credit conditions or austerity. In China, however, the correction is redirected rather than suppressed. Loss-making sectors may contract, but strategic industries expand. Local governments refinance through state-backed entities. Banks restructure loans instead of enforcing defaults. This choreography maintains a stability not by reducing debt, but by reinforcing the pillars that support external reliance on Chinese production. As long as the world depends on China for critical materials and technologies, the internal pressure of debt does not behave according to standard economic logic. Another rarely discussed element is the way Chinese firms internationalize risk. By acquiring stakes in foreign supply chains, processing plants, and logistical hubs, they generate revenue streams that operate beyond domestic financial cycles. These international profits create liquidity buffers that state banks can leverage, making the entire financial system more flexible than it appears. This decentralization of income sources weakens the impact of domestic downturns, creating resilience that conventional debt analysis cannot detect. Through this multi-layered interaction between state banks and strategic industries, China blurs the line between economic policy, geopolitical positioning, and financial engineering. The result is a system where debt does not vanish, but becomes absorbed into a broader structure of influence that extends far beyond its borders. The deeper you examine China's economic strategy, the clearer it becomes that its debt does not operate in isolation. Instead, it is embedded in a framework where asset appreciation, resource control, and global dependency reshape the meaning of financial vulnerability. Traditional models assume that rising debt increases instability, but this assumes a neutral economic environment. China has constructed anything but a neutral environment. It has engineered conditions where the assets it controls appreciate precisely when global challenges intensify, creating a counterweight that quietly offsets the pressure of domestic liabilities. This dynamic is most visible in how China positions itself at the center of future-facing industries. Renewable energy, electric vehicles, advanced electronics, energy storage, every one of these sectors relies on materials that China refines, produces, or dominates in the supply chain. When global demand surges, the value of these materials rises. When geopolitical tensions disrupt supply chains, China's control becomes even more valuable. In both cases, the assets that underpin China's economy strengthen during periods when traditional financial indicators would normally deteriorate. This inverse relationship gives China a resilience that standard debt metrics fail to capture. Another overlooked component is how China uses price influence to manage financial exposure. By adjusting production levels, refining output, or export quotas, it can subtly shape global pricing for rare metals and related commodities. These adjustments do not need to be dramatic. Even slight changes can shift market expectations, raise valuations, and reinforce the perception that China holds irreplaceable leverage. As these assets grow in strategic value, the weight of China's debt becomes less significant relative to the strength of the resource portfolio supporting it. Debt does not shrink, but its relative importance diminishes. This effect compounds when combined with China's long-term infrastructure projects. Railways, ports, industrial corridors, and energy grids built across Asia, Africa, and Europe create economic networks that generate returns for decades. And these returns may not appear immediately on balance sheets, but they create a future income structure that strengthens China's overall economic position. When investors evaluate risk, they increasingly see a nation with expanding influence, expanding strategic assets, and expanding control over global production systems. Debt becomes just one piece in a much larger mosaic. Perhaps the most revealing aspect is psychological rather than structural. Global markets respond not only to numbers, but to narratives. China's narrative is no longer one of unchecked debt growth, but of indispensable economic dominance. As long as the world depends on Chinese materials and manufacturing, the narrative of vulnerability weakens. Investors adjust expectations, analysts soften projections, and governments exercise caution in applying pressure. The perceived risk of China's debt begins to fade, replaced by the recognition that destabilizing China would destabilize much of the global economy itself. Through this gradual shift, China's strategy transforms what should be a financial liability into a relative strength. Debt does not disappear, but it becomes surrounded by enough strategic value that its ability to trigger a crisis diminishes year by year. As China's strategy unfolds, the broader impact reaches far beyond its borders, reshaping the global financial system in ways that many countries have not yet fully recognized. When a nation leverages oil dominance, rare metal control, and supply chain indispensability to dilute the weight of its own liabilities, it changes the balance of power for everyone involved. What emerges is not simply a stronger China, but a world economy recalibrated around the materials and infrastructures that China commands. This shift does not happen through sudden shocks or announcements. It happens through slow, deliberate realignment until the center of gravity in global finance tilts almost imperceptibly toward Beijing. Nations that once relied on diversified supply chains find themselves tied to Chinese refining capacity and energy agreements. Industries that depended on open market access now depend on Chinese pricing. Financial institutions that measure risk through traditional indicators begin to see that these indicators no longer capture the real distribution of vulnerability. As this new reality settles in, China's debt transforms from a potential detonator into a contained imbalance, buffered on all sides by strategic assets that behave like economic shock absorbers. The more the world accelerates toward technologically intensive industries, the more powerful these buffers become. This transformation also alters diplomatic behavior. Countries reluctant to challenge China economically become even more cautious as their own industries become dependent on Chinese materials. Regional blocs seek stability rather than confrontation, and global institutions recalibrate their expectations because the cost of pressuring China grows higher each year. These shifts do not eliminate China's financial weaknesses, but they ensure that those weaknesses no longer operate within the same framework as other nations. Vulnerability becomes diffused, intertwined with the prosperity of those who rely on China's strategic assets. The result is a new form of global interdependence, one where China stabilizes its internal debt through external leverage, and the world stabilizes its supply chains by accepting this arrangement. This is not a temporary strategy. It is a long-term restructuring of how economic power is measured and how financial pressure is applied. And while many countries are only beginning to understand its implications, the momentum behind this shift continues to build quietly, shaping the economic landscape of the decades ahead. If you reach this point, you already sensed how these hidden patterns reveal a different kind of global economic order. If this journey expanded your perspective, consider subscribing so you can follow the next layers of this unfolding strategy. Leave a like to support the work, and drop a comment saying, "This message was for me, so I know you stayed until the end." There is a video right beside this one that continues this line of thinking. Click it and keep exploring these deeper movements with me as we go further into the forces reshaping our financial world.